Hello and welcome to the Monday Futures Market Outlook for January 30th, 2012. This is Patrick Ceresna. For those of you that have not had the opportunity to try out the minisource.com trading room, visit our website for more information about complimentary memberships. In the process of doing intermarket analysis, it's always good to start off with taking a look at the currencies, and we're going to start by taking a look at that US dollar index, which is the future on a basket of currencies against the US dollar. And you can see the US dollar has been consolidating for a better part of 2 weeks. We think there's important support lines down in this 78-79 zone, and really at this stage we do anticipate there to be at least some short-term support here. Overall, while the euro continues to bounce a little bit higher, and we'll look at chart on that in a moment, it's likely the US dollar may even consolidate for a better part of February, but in the bigger picture we believe that this will be a buying opportunity for the US dollar. When we take a look at that euro futures contract, we've been had a 600 pip rally off that low in a span of just a couple of weeks. At this juncture, we believe that that trend will remain in place probably for a good chunk of February. More than likely, we'll see some sort of a give back in the upcoming days here, but more than likely the euro will probably come back to not only retest 132, but could maybe even muster up as high as the 133, 134 area. If there's a real catalyst, maybe we can even see 135, 136. Overall, we believe the euro will fail somewhere up in those zones, but it probably beyond day trading, there's probably still another 3-4 weeks before the really good shorting opportunities should emerge. Next year, when we take a look at that 30-year Treasury bond, after the Fed announcements, the Treasury bond started to rally back up to their highs. The 10-year Treasury note has already popped to a higher high. At this juncture, in the much bigger picture, we are bullish bonds for another breakout, but we were skeptical about whether or not that rally would come off of these existing levels, or whether there would still need to be further consolidation. Our first inclination is to be skeptical about the initial sustainability of a bond rally here, so we're going to come up to some overhead resistance around this 145 handle, and even up at the 146, 147 zones. We're going to maintain our bias that this should continue to consolidate, and it's likely that the next major move in the US dollar to the upside and the next move down on the euro will probably line up with the legitimate breakout on the upside of any bond rally. Next year, when we take a look at copper and copper futures, had a really nice push on the upside to a higher high. See a little doji candle with a reversal bar. At this juncture, copper does need to take a little bit of profit taking. It is likely that these pullbacks could actually be contained even to the 370 level on any pullback. Obviously, a little bit deeper towards 360 is possible as well. Overall, it is likely that copper will, for the month of February, pull back and then probably rally back up to those highs again to kind of bang out the overhead resistance levels before banging out a little bit of a top. Next year, when we take a look at the E-mini crude oil futures contracts, we continue to see crude oil in a very interesting pattern. We have substantial overhead resistance, but at the same time, there really is little to no selling that is causing crude oil to drop. At this stage, all the of our technical patterns continue to suggest that this could emerge as a flagging formation, and once given a catalyst, crude oil could actually make a break and attempt to push even at potentially as high as the 113, 115, but doesn't necessarily have to go that high. We could see maybe just something in the vicinity of the 108 to 107 kind of area on the upside. Nonetheless, we're going to maintain a bias that crude oil could strengthen so long as it holds above this 96 to 98 zone marked by that blue box. If we see any price action substantially weaken below 96 to 98, we would immediately take a far more neutral to even potentially negative stance on crude oil. Next year, when we take a look at the gold futures, gold on that Fed announcement news had a very strong push higher that actually exceeded all standard Fibonacci zones. At this juncture, that we now have to just watch where overhead resistance lays on gold. Gold certainly has made a really good push here, but it is a little bit overbought. let's watch where that overhead resistance and reversals come in. Overall, we are not bullish gold, but if we see over the next 2-3 months some positive price action, we'll have to reevaluate our longer term forecast. But at this stage, maybe at most we have another $25 to $50 upside potential before it starts banging its head into some substantial overhead resistance. So when we take all of that into context and we take a look at that S&P 500 on the daily charts, we wanted to just emphasize that we were seeing some reversal candles and some pullbacks here at this stage after having almost an entire month of pure rallying on the upside. Some profit-taking cycle was in store. We are looking for this flagging formation to develop into something that could even be 1 or 2 weeks in length and see pullbacks on the downside. There is some initial support at this 1275 to 1290 zone, but there could be pullbacks even as deep as the 1250 to 1260 zone on the downside. That more than likely will emerge as a buying opportunity, as probably in late February into March the market will make another substantial push higher to retest some of the high zones, and then that's when we'll be looking for some bigger picture tops. But it's likely that this first pullback over the next week or two will emerge as a buying opportunity for a rally that probably can reach the 1340, 1370 zone on the upside, and if given enough of a catalyst, could even see higher levels such as 1400 or 1450. So for the first quarter of the year, we're going to remain bullish. To put that all into a little bit of perspective, we always like to refer back to that weekly chart of the S&P 500 going back 3 decades, just to kind of identify the primary trend of the markets. And we can draw an 80-week moving average on there. It does that job to depict the bull and bear market cycles the market has gone through. Over the last year, we've gone through a number of false signals going higher and lower above this 80-week moving average. But at this juncture, the market is clearly above that 80-week moving average, while it is pointing higher and trending higher. So at this juncture, the trend is in the favor of the bulls. So putting that all into a little bit of context, our key intermarket observations. So we're likely to see another few weeks of euro upside consolidation, and then during that time frame, the US dollar will probably continue to pull back. Commodities are likely to still maintain current levels, but we feel there is reason to be skeptical about the long-term sustained move on the upside. The stock markets are selling early this week, but again, we think it's a profit-taking cycle that will emerge as a buying opportunity for a continued bullishness for the first quarter of the year. And we do believe bonds will do well this year, but we remain a little bit skeptical as to whether or not this move is beginning right now. More than likely, there should be further consolidation in this first quarter before bonds become more bullish into the second and third quarter of the year. That was your Monday Futures Market Outlook. Thank you for joining me.